recently entered into a partnership with Weather Decision Technologies, and this is allowing us to realize an aspiration that I've had for many years now. I've felt very strongly that to be able to serve all of you as well as possible and provide as much insight as possible regarding what might happen in the natural gas and electricity markets, that it really was essential to be able to closely, thoroughly integrate the kind of market analysis that I do and top flight weather forecasting. And I've really looked for a long time to find a weather partner who I felt could bring the capabilities to the table that we needed to be able to provide the best possible price forecast. And we found them, and this is the first opportunity we've had in a webcast format to present the results of our joint effort. We hope you'll find it valuable. I'm going to focus in the presentation today on the price forecast per se. David will focus on the weather side of the equation. I won't go over my background biography at all. It's here. We will make the PowerPoint presentation available afterwards to everyone who's signed up. So give you a little background about me for those of you who haven't heard me speak or seen some of my writings before. We're going to organize the program into three segments. We're going to cover three topics. One will be our natural gas price forecast for 2015 and 2016. Second, after I've at least started the discussion of our forecast, David will present WDT's winter seasonal outlook, and he'll then hand the microphone back to me, basically for me to complete the natural gas price forecast, and then I'll talk about what natural gas price forecast means for the electricity market. There's obviously, this has been, if I can draw your attention to the graph at the bottom of the slide, and what we've been seeing at least for a year or two now is some pretty incredible volatility in the natural gas market, in the sense that when prices move, they often move violently. And we have seen one of the most violent moves of recent years, just in the short time between right before Thanksgiving and now. We've seen the winter month natural gas futures contracts drop basically 90 cents in really just 7 trading sessions, I think, total. And we were heading until during November, we saw a pretty steep price rise. That's basically, and we were looking as if we might stay above last year's curve, as I'm sure all of you remember. We had last year prices spiked very high, but we've seen all of the recent rise in prices disappear very quickly, and prices go well below year-ago levels. And so from a natural gas standpoint, the obvious questions are, what's going to happen next? What caused that steep dive in prices? Has the market overreacted? Is there still a significant possibility that prices will rise sharply again? If so, how high might they go? Is what we've seen now the low point, or are prices potentially going to drop even further? Those are sort of the obvious questions, and what we're going to try to do in this webinar, between David's input and my own, is to provide our best answers to those questions. And I'm not going to steal the punchline at the very beginning of the presentation. But if I had to signal where we're going, I think I'd emphasize 2 or 3 things. First of all, as always, especially in the winter months, weather will be absolutely critical. 2, as you'll hear, we think there are reasons to be at least very cautious, maybe skeptical might even be a better word, regarding many of the weather forecasts that are out there. I think all of you who follow the weather forecasts know that most meteorologists, at least many meteorologists, have been predicting for months now that we were going to have a relatively normal December and, in all likelihood, a very cold January and very cold February. And we're going to give, David's going to give the WDT forecast, and I won't steal his thunder other than to say, at a minimum, one ought to be very cautious as to how much weight to give to those forecasts. And finally, well, I'm going to give some very specific price forecasts for natural gas later, again, just to give a little bit of a preview. The bottom line would be that our view is that there is probably, notwithstanding the steep decline that we've seen, overall, if we look at 2015 as a whole, looking forward to 2015, there is probably at least somewhat more downside risk than upside potential. So let me just stop for there in terms of the overview of the prices. A little bit just about us and what we're doing. I think most of you are probably familiar with this, but I started forecasting natural gas prices back actually in 2001, before I even started EBW, and started Energy Business Watch a couple of years later, and we publish daily, weekly, and monthly energy market analysis and covered natural gas, electricity, and oil. And we're very proud of our subscriber base. We have a number of major trading floors. We have both major natural gas producers and power producers, and that includes, on the natural gas side, several of the largest natural gas producers in the U.S., and also a number of quite a number of small and medium-sized producers as well, who we think can benefit a great deal from the work we do in terms of their hedging decisions. Our subscribers also include a number of major investment funds, and finally, we have actually quite a number of household name commercial and industrial energy users who subscribe to our publications as well. You know, what differentiates us? I'm not going to dwell on this, but fundamentally, you know, we're particularly proud. We have been best of breed in our storage forecasts, and we're unlike a lot of other market analysis. We give very specific price forecasts, and even near term, when there's always a lot of volatility in the market, we're pretty good almost all the time. I wouldn't say we can call the market perfectly. I don't think anybody can, but we do a pretty good job, even very short term, when there's lots of volatility. And where we're particularly strong is that we have consistently, over really the more than a decade since we started EBW, been among the first to predict significant shifts in natural gas prices. And the way we do that is that we've spent more than a decade now developing what we think are the best tools available for assessing supply and demand. We have, even before our affiliation with WDT, we have always felt weather was critical and tried to, when looking at where the market might head, try to look carefully at the weather and how that will affect prices. And we're a little bit different than a number of others in that while we have a heavy emphasis on supply-demand fundamentals, we also take into account literally pretty much every other factor that we think affects prices, including market technicals and the effect of program trading and sentiment and really a long list of other factors. And over the last 2 or 3 years in particular, we've spent a lot of effort developing an online tool that we call Sapphire that it integrates all of the different tools, the quantitative tools that we've developed over the years to assess supply-demand fundamentals. And that tool is really very powerful. We use it in our forecast, and we also license it to subscribers who are interested in being able to do their own analysis. And it generally allows us, under any particular weather scenario, to predict what natural gas prices will be on average over the 12-month storage cycle within 5 to 7 cents, which we think is a very high degree of accuracy, and part of the reason why we think we can be fairly specific with our price forecasts. What I'm going to do before handing it over to David is I'm going to try to talk briefly about the context that exists in the natural gas market currently and how that shapes our expectations as to where prices might be heading. And I think the starting point for us is something I think you're all generally familiar with, but we nonetheless want to emphasize, which is the tremendous growth that's been occurring in U.S. production, I mean to say, of natural gas. And in a sense, from the standpoint of the producers have been the victim of their own success in that they've been so tremendously successful in continuing to improve the techniques for shale development, that even with very steep cutbacks in drilling for natural gas, we continue to see fairly astounding continued growth in U.S. dry gas production. And one of the things that's really just startling is that if you look at the published data, it shows that over just the last 7 months, we've seen a 4.8 BCF a day increase in dry gas production, as reported by EIA. And I haven't gone back to completely double check, but I think actually that may be the fastest rate of growth over any 7-month period. I have firmly in mind that we've had a couple of recent years, going 3 or 4 years back, where for the year we've had an increase of 5.5 BCF a day over a 12-month cycle, and we had that actually back-to-back for 2 successive years. But I'm not sure that we've ever seen 4.8 in just 7 months, and that's critical. And I think everybody's aware that natural gas production is continuing to increase. As a point of emphasis, I would say we've been pretty good at being able to calibrate the rate of growth, and I think many other market analysis services really have continued to habitually underestimate growth in demand. And we think that's fundamentally because the shale revolution is continuing, and we're continuing to see fairly dramatic increases in efficiency of production, and those tend to be underestimated, not fully taken into account. But if you look at the graph on the bottom of the right, and I guess they're both worth dwelling on. The one on the left, shows you that we're now, over the last several years, cumulatively the total increase in production from shale has been more than 35 BCF a day. Just jaw-dropping. And if you look at the shape of the line, you'll see that it's actually overall for all the plays together. If you look at the portion from, let's say, roughly May of 2013 onward, to some extent, the overall rate of growth is accelerating. And if you look at what it means year by year, the graph on the right shows you the cumulative increases in supply that have occurred over the last 4 years. And as you see, it's very, very steep. We've got, over the last 4 years in the aggregate, there has been a total increase in supplies of on the order of 11 BCF a day plus, and we think it's very important to keep that in mind in trying to think about what might happen to prices over the next 12 to 24 months. Drilling down a little bit more, what that continued is spectacular growth in production has done is basically two things. One, it's created a situation where in normalized terms, that is in scenarios in which weather matched the historical norms, the market is continuing to become increasingly oversupplied. And two, what that's meant in turn is that it takes extremely cold weather in order to absorb a sufficient amount of the excess gas for prices to be north of $4 or even north of $3.50. So if you look at the graph on the left at the bottom, what that's doing is that that's giving the complete picture in terms of the supply-demand balance, in the sense that the supply, the dark blue bar, what that is, it's the net increased supply. That's the figures that I gave on the last graph for increases in U.S. dry gas production minus the offsetting declines that have occurred in imports, which have partially, but only partially, counterbalanced the increases in U.S. production. And then the gray bar are the increases in demand that have occurred over the same time period. And if you look at the last two pairs of bars in particular, what you see is a rapidly growing imbalance in the market, where when you net out the increases in supply and the increases in demand, the gap, the imbalance in the market is continuing to increase every year. And if you can turn your attention to the graph to the right, that's showing really the critical importance of weather and also the range of variability that you can see in weather. The blue bars on the right are just showing our estimate of total space heating demand for each of the last 3 winters. Startling differences, as many of you know, I'm sure recall, 3 winters ago was one of the mildest winters ever. The winter of 2012-13 was not that far from normal, and last winter was one of the coldest ever. And you can see the difference in demand between the mildest and the coldest is on the order of slightly more than 1.8 BCF, 1.8 TCF, excuse me, 1.8 trillion cubic feet, an enormous difference with huge impacts on the price of the market. And you can see the prices also displayed on that same graph. When you look at all that together, what it says basically is for the 12-month cycle, given the continued growing imbalance in the market, for prices to get back to the $4.50 level, we would have to have even colder weather than we had last winter. Last winter, I think, is probably still fresh in everyone's memory. One of the coldest winters of the last 50 years. If you look at the graph at the bottom left, that shows you what that did to natural gas in storage. Natural gas in storage got down to a low right around 822 BCF, if I remember correctly, to be precise. That was, as you can see, way below any other recent years. That was low enough, the fact that we got all the way down to 822, that we were well below the, let's say, 1,000 to 1,100 BCF range was critical, because it meant that despite the very high supply levels last year, storage got drawn down sufficiently, so the amount remaining in storage was starting to get very tight. There it's often estimated that there's maybe about 800 BCF of storage needed just to operate the system. So we were getting somewhere, we were testing just how much gas we could withdraw from storage, and that in turn led to very severe price spikes, as you can see in the graph on the right. What happened afterwards, though, was instructive, because while prices spiked in the winter, even last year when the supply-demand balance was not as loose as it is currently, essentially we wound up, even despite having only 822 BCF in storage, as all of you are familiar, we were able to really completely refill storage in terms of what's adequate under current market conditions. We injected 2,789 BCF into storage, by far an all-time record. Graph on the left shows you just a huge increase in storage. And parallel with that, we saw prices drop essentially consistently all during this year's injection season. We had a period in November where we had very, very cold weather in November of this year, and that caused prices to run up sharply. And it's important to understand what was going on there in terms of understanding what may happen next in the market. If you look at the graph on the right, essentially what you're seeing, if you look at the period between September 14th and late October, what you see during all that time period, the winter month, the 2014-2015 winter month contracts, and the January 2015 contract in particular, were selling only at a relatively modest premium, 20, 25 cents, sometimes even lower, to the average price of the April through October 2015 injection season. And what that was reflecting was a belief on the part of the market that even with the forecasts that we were getting from a number of the other vendors that were predicting a very cold winter, basically, and particularly extremely cold January and February. There was one major forecaster who we respect and work with, had their webcast earlier this morning, and they're still predicting in January and February a total excess HDDs on the order of, let's say, 125 HDDs or more, which translates into something on the order of almost 200 BCF in excess demand. And notwithstanding that expectation that we have very cold January and February, the winter month contracts were only selling at a modest premium to the rest of the balance of 2015. And that basically reflected a belief that even with that kind of cold scenario, that storage would never get down. Storage this winter would never be drawn down to the level where we had the kind of upward pressure that we had this year. And then we had, and WDT was spot on in being one of the earliest to predict that we might have an ultra cold November. Did that at a time when a lot of other forecasters were predicting fairly moderate weather in November. And what that did is that it finally, for a period of time, created a belief in the market that storage could again get very, very tight if we had a very cold November and a very cold December, and the forecast for January and February proved to be correct. And so if you look at the difference between the blue line and the black line during the period between late October and just before Thanksgiving, you'll see that the difference, the premium for the winter month contracts, grew to be huge. And that's what led to the steep run-up in prices. And what's happened now is that, as you're all aware, we're at the start now of a period in which really all the forecast indicators from almost across the board indicate that at least for the next 2 or 3 weeks, we're likely to have extremely mild weather, and that period of much lower than normal demand has reduced dramatically the risk that we'll have tight storage anytime this winter. And so what we've seen, just if we look at the far right of that graph, just in the period since the day after Thanksgiving and now, the premium for the winter month contracts has basically collapsed to just nominal levels again, and that's essentially what set prices down. And here's WDT's forecast for the 6 to 15-day window. We're at a period now during mid-December where I think it's become pretty clear to everyone that this is what we're likely to see for at least a period of 2 or 3 weeks. And the question, the $64 question at this point, is what's going to happen next? Will there be a significant shift in the weather? If so, when and how severe, and what will that do to prices? And that's what we're going to focus on during the rest of the webcast. And I would say we're particularly proud to be doing this with WDT. And I want to explain just briefly, before I turn the microphone over to David Gold, why we're partnering with WDT in particular. And it's really a product of my personal judgment after more than a decade of working with almost every meteorologist. And I have a lot of respect for a lot of people in the field. But in the end, my belief for a long time now has been that the community of weather scientists should be able to do better than it's been doing thus far. My belief, and I'm just going to be very direct on this, and again, this is not a criticism of any individual personally, but I think there are really flaws in the methodology for forecasting that are being used by most of the vendors there. I've tried to list the most significant. One is that many vendors depend very, very heavily on progression models and historical analogs, and I think there are flaws in both those methods. The science is actually very clear with the progression models that the flaw is that unless you can specify the initial conditions in the atmosphere essentially perfectly, that any progression model that tries to build on that and say how the forecast will evolve tends to break down very quickly and really ceases to be all that reliable after as soon as 5 to 7 days out. And I think also, I think there's a real limitation in the method of relying very heavily on historical analogs. As I mentioned before, right now, most forecasters are still relying on the notion that we could have a weak to moderate El Nino conditions in January, 5th, and February, and the key to most of their forecast is really just looking at the historical analogs and making the observation that at least in recent years, when we've had weak to moderate El Ninos, it's slightly more likely that, in their view, that it'll be colder than normal, than warmer than normal. But A, if you look at the data, it doesn't really provide very much support for that. But B, to the extent it does, it really just tells you that, if you don't know anything else about what's going on in the atmosphere, there's a slightly greater chance that it'll be cold. And basically, I think we ought to be able to do better. And I'm going to turn the microphone over to David now, because WDT does have a very different methodology. WDT uses, it's not that they ignore progression models or historical analogs. They definitely use those, but they use those just as a starting point. And David, if you could pick up from there and explain what you do differently, I think, and just in a couple of minutes or so, and then turn to your forecast, that would be very helpful.
Thank you, Andy. Well, I'll get right into this. First, I wanted to say that we here at Weather Decision Technologies are very pleased that EBW and Andy have elected to work with us, and we hope that over time that this relationship will be beneficial. First, because of the possibility that in this space few have heard of us, I wanted to introduce the company and who we are. We have about 80 full-time employees. We're a weather provider, and that's both weather as a service and also software as a service. We have about 80 full-time employees, a little bit more now, quite a few with advanced degrees, and quite a few with degrees not only in atmospheric science but computer science degrees. WDT has been recognized for excellence in corporate service and has a large amount of proprietary technology that's pressed into service for everything from feeding very popular apps such as Radar Scope to an increasing number of asset protection clients. And under the vision of our CEO, Mike Iltz, he had a very bold vision that they wanted to expand the scope of what WDT does. And so WDT opened a satellite office in Houston and brought a number of us together that had been working previously in some capacity at other locations. Jason Lynn, who sort of oversees the operation, he and I worked for a short time together at Iberdrola and collaborated for years afterwards. Jason and Ed worked together at various stops. We've all had extensive experience in making forecasts and doing research in support of forecasts that serve the commodities industry with a focus on energy. And we all have a shared vision, which is basically to bring best-in-class weather practices to the operational forecasting endeavor. And we very quickly, Jason and I became early adopters of a framework tailored for making particularly subseasonal forecasts, which basically is that range of time from roughly week 1 to about week 6, kind of spans weather and climate. And we became early adopters of a conceptual framework that seemed to be particularly good for making these kind of predictions. This was pioneered by Ed Berry in collaboration with a scientist, Klaus Weissman. And this has been successfully leveraged on large trade floors over the years. There's been real kind of proof of concept as we've applied these practices. And we sort of saw an opening to bring these practices to the market at large. So I wanted to briefly touch on the mainstream forecast process and how we think we differ very briefly. The overwhelming majority of weather providers start and end with numerical weather prediction, what we all know as the weather models. The problem is they suffer from systematic biases and weather climate regime dependent errors. An example is the climate model forecast that missed the November cold snap. And what happens is that essentially they revert to the climate trend and results in showing a lot of anomalous warmth over a large area of not only the high latitudes where that trend is most strongly observed, but that also tends to bleed down into the mid-latitudes, and the models as a result can completely miss important variances from that trend like we saw last month. No doubt that numerical weather prediction is the greatest advance in the history of the weather forecasting enterprise, but use of this alone, it's not sufficient. You really have to have some framework for interrogating the observations and the data and try to come up with some sort of a view independent of the models that then allows you to place the models in their proper context and use them as the tools that they're designed to be. They're not designed to be the end-all be-all, but rather tools in the forecast process. So very briefly, what we do is employ something called the Global Synoptic Dynamic Model. Now, this acronym, like so many others, seems like gibberish, but the thing to emphasize, it's global in scope. So it can be employed for making forecasts across the globe for a variety of parameters. Basically what it does is it serves as a way of organizing and understanding the myriad of complex processes, feedbacks, and interactions that comprise the atmosphere-ocean system. And of course we need a way to make all of this data tractable and usable, and we need to organize it so we can come up with a coherent forecast process. And that's what this does. And it's very good at doing things that run the gamut from interpreting and accounting for model error and model bias to catching extreme events, catching the timing of pattern transitions, and it can help to determine whether a persistent pattern has emerged, and that may be relevant in the present case. Of course, like any system, it's not perfect, right? It depends on the expertise of the practitioner, and because of the nonlinearity and the chaos of the system that we're trying to predict, you know, there are fundamental limitations. So let's move from that discussion of a framework that we use to a specific application of it. And this is our latest 16 to 30. And right now, what we're concerned about is that we've had something amounting to a new persistent pattern emerging. Now, obviously, last winter, for various reasons, we got stuck in a persistent pattern that brought a lot of cold weather east of the Rockies. Here in December, the pattern flipped. And at first glance, you know, it may seem to the casual observer who doing some diagnosis that, well, this is just what happens in these weak to moderate El Nino events in December, but it's actually quite a bit more nuanced and complicated than that. Certainly, I don't intend to go into any details. Just suffice it to say, we have some concerns that this pattern will most likely persist, at least through the end of December and possibly beyond. An alternative, lower probability but non-negligible possibility is that the pattern flips. You know, how might that happen? Well, one way it could happen is the pattern just amplifies again, leading to a release of more cold east of the Rockies. One way in which that can manifest is that this big high pressure ridge dominating much of North America that's now unfolding simply shifts westward. And that's something that does commonly occur during winter to create transitions from widespread mild patterns to colder patterns. Much more problematic, as everybody realizes, is the endeavor of making a seasonal forecast. And you know, the thing with seasonal forecasting is you've got to latch on to very slow processes and see evidence that these processes are significant and will continue. And when you strip everything away and you really look at the weather climate system, what you really find is that, you know, the El Nino Southern Oscillation is a significant and just about the only process that fits the bill. However, that weather climate linkage framework that I talked about is a key thing to monitor and to use to try to catch important shifts from the baseline seasonal view. Now, right now, we have a very weak lean toward a scenario that calls for this present pattern that we seem to have gotten locked into to persist, albeit with some muting of the warmth. Part of that is just trying to capture a monthly mean, which I'll add is also very difficult for a seasonal forecast. Ideally, one would want to target 3-month means, but you know, given the nature of what we're doing and the fact that we are in the business of making these kind of forecasts, our best guess is as presented at the upper left. But notice again, right now we're sort of at a tipping point in the atmosphere where a lot of complex processes are competing for dominance. The idea we built into our forecast, though, is that at some point, perhaps similar to what other practitioners may be advocating, we may very well see a flip. And the exact timing of that flip and how that occurs, those details are very uncertain. But suffice it to say, sort of our overall primary scenario can be seen as an evolution. Now, one of the primary drivers for the pattern on seasonal timescales is the warm waters of the West Pacific, primarily from the eastern Indian Ocean through the West and Western Pacific. And in an El Nino event, those waters, they slosh eastward. Well, this warm pool, if you will, has not really come very far east. It's still stuck largely west of the date line, and now with the seasonal cycle is shifting south of the equator. And that's important for various reasons, because as we get into especially mid-January and beyond, seasonality favors the flare-up of intense and durable and persistent thunderstorm clusters. When you have a body of water as warm as the sea surface of the western and central Pacific Ocean is right now, and I'm talking about in the tropics, that is a hot plate that inevitably becomes active with large-scale tropical thunderstorm clusters, and these directly impact the circulation. So a key is, how does it impact the circulation? Well, we saw one way last year. In December, we set up a pattern primarily due to dynamics internal to the jet stream that began cold air delivery into much of the central U.S. during December. Convection turned on, So a metaphor would be giving gas to your automobile, and just like an acceleration occurs in the car when you hit the gas, when the convection began firing over those warm waters last year, which was coming eastward, and we think that's also important in some ways, it amplified the existing pattern, made the response of larger scale and more durable. This year, we think there's a possibility for something like that to happen again, except we find ourselves in a different kind of pattern. So the question is, are we going to get in a situation where this engine kicks in and drives the pattern markedly colder? And right now we do think there's a risk, but the precise timing is unclear. An alternate scenario would be for this warm pool to engage the circulation rather earlier, resulting in a flip to cold in January. One can also see an alternative scenario for February, and the way I would sell that is basically the idea that for some reason we don't adequately change the pattern through any means, and we just wind up stuck in neutral with the pattern more or less that we have now. That's more of a classic El Nino type look. In fact, I'm showing here patterns at the top. This sort of goes along with our primary scenario, and the bottom, you know, would go along with the alternate scenario, just focusing on midwinter, for example. So of course the top pattern looks like a pretty classic strong El Nino, except we're not really in a strong El Nino setup. We've got a pattern that has some aspects that look like they're El Nino-like, as we like to say, but they've arisen due to other causes. And again, what could happen is at some point in the winter, the pattern at the top where you get a jet stream that you know comes across the Pacific, that's certainly happening now, although it's at a high latitude, it's at about 35 north. That may come south and split across North America, perpetuating this warm pattern. It's an El Nino-like pattern, but for different reasons. The alternative scenario is that at some point we begin to reverse that. That whole entire setup begins to unravel. We take the high pressure ridge that I've marked in the top panel near Hudson Bay, and it shifts westward, basically setting up a much colder pattern with a downstream trough over Hudson Bay, as indicated by the white L in the bottom panel. And that is a transition that could very well occur at some point. And the only way we're going to catch, number one, whether that does occur and the timing of it, is to use our conceptual framework, our forecast framework, to rigorously monitor and diagnose trends to catch such a transition. Thank you.
Thanks, David. The question is, where does that leave us in terms of what to expect? And let me explain what the starting point is in my mind in terms of what I'm looking for in terms of input regarding the weather. And that is, I'm tired of being surprised. I'm tired of going through year after year in relying on various forecasts that it often turns out to be that the weather is the antithesis of what's predicted. And so what I've asked WDT to do, and David has just done, is that I've asked them to both give me their best shot at a primary forecast, and essentially to let me know what could change things and what could result in the weather being significantly different than their primary forecast. And that's what David has just done. And my job basically is then to try to translate that into actionable information for all of you as to what might happen to prices. And that obviously, given the diversity of the subscribers to our publications, that has different implications for different types of subscribers. But the starting point is for us to be able to give you the best insight that we can as to what might happen with prices, and to put odds on various outcomes so you can make the most intelligent decisions possible. And within that general context, essentially, what messages do we draw from the forecast that David has just provided? Well, number one, at the outset, the question I asked was, could prices still rebound, and if so, how strongly? And that, in turn, it depends upon essentially whether the other vendors, the view that's being offered widely now that we're going to have a very cold January and February turns out to be correct. And what I would say are a couple things. One is that based upon the kind of analysis that WDT does, based in particular on their 16 to 30-day forecast, and I'll flip back to that for a second just so you can have it in front of you. If you look at their 70% forecast, that forecast calls for the current mild weather to in all likelihood persist at least through the end of December and quite possibly longer. And that forecast tells me essentially that the likelihood that we are going to get a very strong rebound is really pretty low. I would say that looking at the WDT forecast in the aggregate, that essentially I think the likelihood that we're going to get sufficiently cold weather quickly enough so that we'll get prices going, the prices for the winter month contracts going substantially above $4 on a sustained basis has become very low. That I would characterize it as being in the range of no more than 10 to 15%. I would say further that for that to happen, essentially weather is going to have to turn much colder really quite quickly. We reviewed earlier the issue of the risk premium built into the winter month contracts. And essentially every week that passes without temperatures turning much colder, the likelihood that the risk premium is going to go back up significantly gets lower and lower and lower. And the reason that occurs is that every week where we have very mild weather increases the likelihood that we'll have more than enough natural gas in storage at the end of the winter. And so I would draw from the WDT analysis a fairly strong conclusion to the effect that we've reached a point in the season that the effect of the mild weather that we've already had and the effect of the prospect that the mild weather will continue for at least another 2 or 3 weeks and possibly quite a bit longer has really reduced to minimal levels the likelihood that we're going to see a very strong rebound in prices. Now, it still wouldn't surprise me if by the last few days of December that we start to get very cold weather. I would expect prices to move upward significantly for a relatively short period. I would still expect them not to get any higher than 422. And further, I would further expect that even if we have a very cold January and February, even if some of the other forecasts turn to be valid, that we are not going to be able to sustain prices over $3.50 during the balance of 2015. That we are, if you look at the overall supply-demand and balance in the market, that even under the more bullish scenarios advocated by other forecasters, that we're likely to see considerable downward pressure on prices over most of 2015. What do I think is more likely? I've said that the real bullish scenario, I'd say now, is no more than 10 to 15%. I think there is a very high likelihood that WDT has bounded what will happen fairly well. That I think there's an 80% probability or more that the total space heating demand during the period through the end of February will be no higher than under their most bullish forecast and no lower than under their most bearish forecast. I think we've got a pretty good range established. And what these two graphs show you is what that means, that under either of those scenarios, the primary scenario is in the medium blue, the alternative scenario is in the light blue, the demand for December, January, and February combined, the number of heating degree days shown in the graph on the left, is going to be way below last year under either of those scenarios. And if you look to the right in terms of space heating demand, the space heating demand is going to be also substantially below last year's space heating demand. And all that, I think, is going to be in the context that I described at the outset of a market that is even more out of balance than it was last year, where the oversupply condition in the market has become even more severe. If you look at the graph on the left, that shows you where what we think would be most likely to happen with the amount of natural gas in storage if prices stayed at current levels, and it compares it to last year. The two lines at the top that are really almost on top of one another are David's two different scenarios for this winter. They reflect different patterns, but when we run through our models, while the location of the cold weather and the timing of the cold weather and the location of the mild weather and the timing of the mild weather differs between his primary and alternative scenario, under both scenarios, the total heating degree days over the December through February are relatively close to one another, and therefore the outcome in terms of storage is relatively similar. And what they both show is that under either of those scenarios, the storage winds up being at current price levels, at the price levels as of market close yesterday, winds up being above 1,500 BCF. And we think that's ultimately not sustainable. We expect that storage most likely will come in at least slightly below that. And further, if it comes in at that level, it's setting things up for a steep decline in prices later in the year. Because if you recall, during this year's injection season, during the 2014 injection season, we injected almost 2,800 BCF into storage. So if we ended this winter with 1,500 BCF in storage and injected 2,800 BCF on top of that, would be up to 4,300. That will never happen. So that if WDT scenarios are in the right ballpark, we think prices are inevitably going to come down even further than they are right now. What the graph on the right is showing you is specifically where we think prices are likely to land during the injection season. And what that's showing you is that we think prices under the primary scenario that has slightly more cold weather, that prices are going to wind up somewhere near 320 during the injection season. And during under the alternative scenario, it might be closer to 315. And in both instances, that given the uncertainty on the weather, we would put an error band around that. And error band is an uncertainty band, is what I should say, on the order of 5 or 10 cents. But basically, we think what we're going to see overall is that during the remainder of 2015, that prices are going to drop further from the levels that they are right now. And we think heading into 2016 that the oversupply condition in the market is likely to increase somewhat further, which could result in an even further reduction in prices during calendar year 2016. In terms of the exact scenario that'll happen between now and the end of the injection season in mid-November, it will depend to some significant degree on when the transition to colder weather occurs, whether early in the season, and how cold the weather is. What we would expect currently, based upon WDT's primary forecast, is that there will only be a modest further bump up in prices, if any, and that it will fade during the course of the winter, and that it will fade well before the end of the winter. But essentially, if prices remain close to current levels on average in late December, January, and February, essentially that will exacerbate the oversupply condition and will drive even lower the prices that we might see in the spring, summer, and fall. And so we'd say at this point, there still is some possibility by the time we get to fall that we'll seriously test the $3 price level. So, the bottom line in terms of our price forecast is where I started with the natural gas price forecast, and that is we are skeptical regarding the forecast for very cold weather very soon. Even if that occurs, we expect any increase in prices to be to be relatively short-lived, and in the more likely scenario, we expect natural gas prices to, over the course of 2015, head slightly lower than where they are now, even after the fairly violent 90-cent drop in prices that we've seen over the last 7 trading sessions. Let me having a little bit of trouble advancing the slides. Let me just comment briefly on what this means to our electricity prices. And what we think is, given the WDT forecast, which even when the transition occurs to colder weather, call for the cold to be not nearly as severe as other forecasters are predicting, that we are not likely to see price spikes in the electricity markets in the Northeast nearly as severe as last year. And we've already seen that to some degree in electricity futures starting to head downward. We think another factor that's very important to be aware of in the electricity market is the effect of the decline in oil prices. That essentially, that's really quite significant in the electricity markets, particularly in the Northeast. Essentially, what's evolved in the Northeast is that on days that are very cold, the oil-fired generation becomes the marginal source of supply. Last winter, if on days in which oil-fired units became the marginal source of supply, the price to operate the oil-fired units could be in the neighborhood of $225 to $250 a megawatt hour. Given the huge drop-off that we've already seen in oil prices, and we think oil prices are going to drop even further, that ceiling price goes significantly lower. The other big issue in the electricity markets is that there's a lot changing, and I won't try to go into any of this in any detail now, but environmental requirements are having a huge potential effect. Also, as more generation is being retired, the regional transmission organizations are realizing that there may be that the amount of generating capacity available to serve the market may be very tight. That's led to some proposals for major changes in pricing of capacity in the eastern markets, and those we think are still likely to go forward, and those will result in increases in capacity prices that will partially offset the lower energy costs that we're perceiving. But right now, overall, in the net effect, we think we're going to see some continued decline in electricity future prices. So what we provided today is really only a starting point in terms of a broad overview of the market. We invite you to work with us further. We'll be issuing our seasonal outlook soon, which will go into these issues in a great deal of detail. We're also offering to everybody who's attended today's webcast a trial subscription to our new publications, and we hope you will find them valuable. We feel that they're really almost a unique offering in the market because of the fact that we are using what we feel is best of breed weather forecasts, and because we're integrating the weather forecast in our price forecast in a way that our competitors are not yet doing. So appreciate very much your attendance today, and we hope to hear from you soon. Thank you very much.